Hello students, good morning. We have already come across first chapter. In that chapter, we discussed what is finance, what is business finance, what is financial management, what is the scope of financial management under traditional approach and modern approach, and even we discussed objectives of financial management. That is profit maximization objective, wealth maximization objective. And at last, we concentrated on why so much importance is attached to financial management. Means what are the reasons for which attaching so much importance to financial management. We are moving towards the second chapter. The chapter heading is capital structure. What we are going to discuss in this chapter? In this chapter, we are concentrating on what is capital structure, how to calculate capital structure, what capital structure of an organization involves, what is debt equity ratio, how to calculate debt equity ratio, then what is the significance of having more debt equity ratio as well as less debt equity ratio. Then we are concentrating on a very important concept of FM, that is trading on equity. And at last we are concentrating on three types of leverages. First one is operating leverage, second one is financial leverage, third one is combined leverage. So this is what we are going to study in this chapter. Before we moving towards what is capital structure, let me see what we studied as scope of financial management under modern approach. Modern approach says that financial management is not just restricted to raising of funds. It moves beyond it. That is utilization part. So, as per modern approach, financial manager have to take four important decisions, financial decision. First one is fund requirement decision. Second one is financing decision. Third one is investment decision. And fourth one is dividend decision. What is all these decisions consist of? Why so much importance is given to all these four important decisions to be taken by financial manager? We have already concentrated or we discussed in detail. Of those four important decisions to be taken by financial manager, second one is financing decision. What is financing decision? It is nothing but deciding how to finance fund required by the organization. If you are a financial manager of an organization and your estimation says that your organization needs 30 lakh rupees for next 6-month planning period. Planning period may be 3 months, 6 months, 1 month, 1 year. It depends upon the discretion of the financial manager. So in case if you are a financial manager and you estimated 30 lakhs is your fund requirement for next 6 months. Out of the 30 lakh, you have to decide how much fund you need from a long-term source and how much fund you have to raise from short-term source, because there are only two sources available to you. Medium term is there, we are not concentrating on it, long term as well as short term. So if you take decision to finance your 30 lakh rupees from making use of various long term and short term sources available, then that constitute finance decision or financing decision. So it's very clear that financing decision is nothing but deciding about how to finance fund required by the organization. This decision of financial manager carries so much importance because there are alternative sources of long-term and short-term funds available to him. Again, within the available source, there are n numbers of alternative mix available. In the sense, if you want to raise out of 30 lakh, you need 20 lakh long-term source from long-term source and 10 lakh from short-term source. Again, how can you raise this 20 lakh? There are n number of long-term sources available. Of those n number of long-term sources, if you take 2 or 3 sources to raise this 20 lakh, again, how can you mix these 3 sources you identified as long-term sources of fund to raise your long-term requirement of 20 lakhs? So means alternative sources are also available and alternative mix is also available. That's why it is not that much easy to take financing decision. So we know that there are 2 sources available. One is long-term source and other one is short-term source. What are the various short-term sources available? You can raise short-term loan. You can go for bank overdraft. You can go for cash credit facility. You can make use of money market securities. These are all various short-term sources available. What are the various long-term sources available? You can issue equity shares. You can go for issuing preference shares. You can rise by issuing bonds or debentures. You can raise loan from banks or financial institution, both secured as well as unsecured. So these are all various long-term sources available. So if financial manager takes a decision of mixing both long-term and short-term source of fund available, what decision he is taking is called as financial structure decision. Financial structure decision is nothing but mix of both long-term and short-term sources of funds in total capitalization of an organization. If financial manager decides to raise entire requirement from various mix of long-term sources available, then he is taking capital structure decision. So financial structure means mix of long-term and short-term sources. But capital structure means mix of what term source? Long-term source. So it is very clear that mix of various long-term sources in the total capitalization of an organization constitute capital structure. I'll explain. I have already informed you there are n number of long-term sources available, of which important sources are equity, preference, debt, long-term loan. Assume that you decided to raise your 20 lakh long-term requirement from equity and debt. What is the mix of equity in the 20 lakh? What is the mix of debt in the 20 lakh? So taking for example, you thought of rising 60% of 20 lakh from equity, 40% of 20 lakh from debt. That 60:40 indicates your capital structure. Means mix of long-term source. What is the mix? 60:40. There are n mix. You can mix it in n ways, both debt as well as equity. You decided to raise 60% from equity and 40% from debt. So it means 60:40 or 6:4 or 3:2 is your capital structure decision. That is mix of long-term source. So that constitute capital structure decision. When you look at various long-term sources available to a business concern, usually business concern concentrate on use of debt and equity rather than making use of other sources. So we should know what is debt and what is equity. Any source of funds that gives creditorship status to the supplier of fund is called as debt. Means when you take a loan from bank is a creditor. So bank loan is debt to you because the supplier of bank loan is bank. So bank had become creditor to your organization. So any source of finance gives creditorship status to supplier of fund is called debt. You can raise funds from issuing debenture, that is debt. You can raise funds from relying on loan from banks or financial institution, so that is debt. So whichever provides creditorship status to the suppliers of fund, that constitute debt. Here creditorship provision means provider of fund will get interest for the amount they provided at an agreed rate. So that is what creditorship. See, if you get loan from bank, so bank will get back a fixed rate of interest for the loan granted to it. So that is what creditorship provision. Bank cannot become owner of your organization. It won't get ownership provision. It will get only creditorship provision. So that is what debt. So what debt involves? Both secured and unsecured long-term loans, debentures, bonds, any long-term loan that constitute debt provided it carries a fixed rate of interest. Usually debt, debentures, bonds, long-term loan carries a fixed rate of interest. What is equity? Any source of finance that gives creditorship status to suppliers of fund is called equity. Here, not creditorship provision, any fund which gives ownership provision to the suppliers of fund, that constitute equity. So now the question is, what equity involves? Equity involves, or equity indicates net worth of an organization. What is net worth? Net worth is nothing but sum of equity share capital, preference share capital, reserves and surplus created out of profit. So it's very clear that equity provides ownership status to the suppliers of fund. Debt provides creditorship. Creditorship status is nothing but providers of debt will get a fixed rate of interest for the fund they provided. But equity provides ownership status. So equity can also means net worth of an organization. Net worth is nothing but equity share capital plus preference share capital plus anything belongs to equity shareholder. Anything belongs to equity shareholder means reserves and surplus. Then profit and loss. In case if it is a profit, we should add it. In case if there is a loss, we should deduct it. Security premium account balance, if any. So that is what equity. To arrive at the exact equity, from all these, what equity constitute, we should deduct fictitious assets, which I am going to explain in the next aspect. So this is all about debt and equity. So almost all organization rise its long-term requirement by making use of two important sources, long-term sources of fund, that is debt as well as equity. So here arises calculation of debt equity ratio of an organization. So out of total equity or net worth, what is the debt portion? That must be calculated. So that is nothing but debt equity ratio. We know that equity and debt has its own distinctive characteristics which you studied from PU level. Whenever you raise funds from debt, you need to pay interest as return to their investment, whether you earn profit or incur loss. Whenever you raise funds from equity, it is not necessary on your part to pay dividend, a fixed rate of dividend. It doesn't mean that you are not going to pay, but there is no such obligation, but there is obligation in case of debt. Even though there is